Hey, Dan Passarelli here. It has been quite a week for the market. Holy moly, we've had over 81% of the S&P 500 companies announced earnings within the last within the last 3 weeks. So we're four-fifths of the way there. We still have retail earnings season coming up. We have this chart here with two big gap days in a row. S&P 500, as measured by SPY, jumping up above the 200-day moving average, the 21-day moving average, and then today jumping up to close above the 50-day moving average. Now, those are all very key levels right there. The 21-day moving average tends to see momentum. The 200-day and 50-day moving averages tend to act as support or resistance, and once resistance is broken, becomes support. So we might end up having a little bit more follow through on that. Although they also say gaps are made to be filled, which means at some point we would expect to see some retracement down lower to fill these gaps, which may or may not put us back below the 200-day moving average. Now, all that being said, we also see the implied volatility, specifically the VIX, at 15, which is about the median for the past 6 months. If we go out to a year chart, we're actually in pretty low territory for implied volatility. So all that option selling that we've enjoyed over the last few weeks here could be drying up a little bit as options get cheaper and cheaper. That said, if we do get a retracement lower, we will see that implied volatility pump back up and opportunities return to us. Now, that said, speaking of opportunities and low volatility, those who are looking to play a retracement to fill the gaps would benefit from buying some puts against long-term assets, because you can buy those puts for pretty darn cheap right now. Well, there's some food for thought for the weekend. Hope that helps. This is Dan Passarelli, Trade Smart.